Welcome to Ask Fear and Greed, where we take your questions and do our best to answer them. I'm Michael Thompson, and hello, Sean Aylmer.
Hello, Michael.
You sound apprehensive, Sean.
I do.
You need not be apprehensive. Today's question is a great one. It is from Joe, who has sent this in via LinkedIn, and you can go to fearandgreed.com.au or LinkedIn or Instagram or Facebook, any platform that you like, and send your question in. And Joe says, last week, or recently, you told us that ETFs are at an all-time high, and exchange-traded funds are set to have more than $300 billion in funds under management by the end of 2025. Joe has clearly been listening.
Like
Indeed.
Joe early.
Thank you, Joe. Then she goes on to say, ETFs look like they are here to stay. How will the growing number of ETF products influence the landscape of stock markets globally, and what will be the long-term effects of this? But wait, there is more.
Mm-hmm.
Will there be downsides and risks associated with this shift throughout the economy and reflected in investor returns? So maybe you were right to be apprehensive, because there's actually a lot in this.
How long is a piece of string? Yes is the short answer, Joe, but I'll go into a bit more. So what are we talking? We're talking about ETFs. So an ETF is a managed fund. You can buy and sell it on an exchange like the ASX. When you invest in an ETF, you're not actually buying the stock, you're actually buying a unit in the fund. So keep that in mind. You can have passively managed ETFs. So most Australian ETFs are passively managed. They don't try and outperform the market. They just say, let's mirror the ASX 200 and let's mirror tech stocks, something like that. You can also have active ETFs and hedge funds. They're basically actively managed investments. So they try and outperform the market. So that's what we're talking about, ETFs. The pros and cons. So the pros, diversification is a great thing. So people often want to invest in banks in Australia. Great investment. Let's invest in banks. Do I invest in Commonwealth or Westpac or National Australia Bank or ANZ or Bendigo? And an ETF solves that for you. You just like banks, so you're buying all the banks. So diversification is good. It's pretty transparent. So you're buying this, you've got to buy on this unit, you get it priced every day, relatively low cost. So if you went and bought all those banks yourselves, just buying an ETF is probably cheaper than buying all those banks. Easy to trade. You can just buy and sell. The flip side, there are cons to it, is that they call it tracking error. And so what your ETF is supposed to be tracking, it may be a bit late, a bit delayed, and you can actually lose money that way. If you're buying international assets, there's all sorts of currency risk. Sometimes they're not as easy to buy and sell as you might think, because they might have invested in really unusual things. So there's liquidity risk, etc. So the question is, what does this mean? They're growing.
I love that you've just completely I could step out of the studio right now, and now you're just asking yourself questions.
Well, no, I am, because I'm trying to think of the answer, but as that, I have to go back to kind of the basics of what they are.
Yeah.
So if you know what they are, just the fact that more people are investing in ETFs suggests then that they're taking a pool of money away from investing in Commonwealth Bank directly or investing in bonds directly or whatever.
Okay.
So they will have a more influential impact. The flip side, of course, is because we all pay 11, 12% superannuation, there's so much money going into the market that there's sort of plenty of money for everything.
It may not matter that much because there's enough to go around.
Yes. What it does sort of mean is that if something hits a sector, so interest rates hit banks, then all the banks get a bit hit the same. So an ETF makes a sector a little bit more generic.
Okay.
For want of a better term.
Yeah.
Because people aren't buying Commonwealth Bank, they're buying the banks.
Yeah.
So if they're buying or selling, it's all of them. It's not just one. So certainly long term, so that in a sense is either good or bad, depending on what you think. Long term, if we keep having this flood of money into ETFs, then they will have greater power over the market. So, whoever holds the owner of the ETF, whichever company has it, becomes kind of powerful in terms of what they're going to do. Now, there's a difference here. Where we talked about passive and active ETFs, a passive ETF just follows the market, and active ETF does more than that. And so if someone owns, let's say it's a company, ABC, I invest in ABC because they have this ETF, they will become more powerful the bigger their ETF is.
Okay.
So there's a bit of that.
Could there be a scenario as well when there is as much or more money invested in an ETF that is tracking a particular sector than there is in the sector itself? And it may not be the case in, say, banks, because those companies are very large. Commonwealth Bank is obviously the biggest company. But you get to some of the smaller sectors on the ASX, and could there actually be more money invested in the ETF that is tracking that sector than there is in the sector itself?
No, because I think the ETF is a subset of the total investment in the sector.
So it's always going to just be counted as part of it. Yep.
But your point is still the proportion of money could go from 5% to 80%. Yeah. And then suddenly you get a regulatory change, or you get Donald Trump saying something, and everyone says, oh, we hate gold all of a sudden. Yeah. And so they're selling out ETFs. So it could have a really big influence that way.
Okay. Have we answered all of Joe? There's a multi-part question.
Not very well, really. Not very well.
Well, we've talked about downsides.
Yes.
We've talked about the risks of perhaps a disproportionate effect if there are changes.
Yes.
And the fact that it's making the perhaps sectors more generic, and perhaps that actually absorbs some of the risk.
Yes. I mean, it does. When ETFs are used in portfolio management to generate outcomes that are different from the broader market sometimes. So when people are trading, for every buyer, there's a seller. So the net effect is zero. And so will ETFs outperform? How do active ETFs? They'll have more sway generally than they do now because they're getting bigger.
Yeah.
But there's a lot of money out there. You know, like a super fund is always going to be bigger than an ETF fund. Yeah. He says.
Yeah.
That's probably true.
Well, yeah. And they're getting bigger.
Yeah.
Constantly.
Yeah. Yeah. I don't know that I've really done much of a job. I mean, I kind of think we've got the concepts there. I think we have to wait and see long-term how it plays, but ETFs will certainly be more influential in markets.
Okay, so what I might do is I might mark on the calendar. So we will come back and revisit this Ask Fear and Greed in 5 years.
Excellent.
And see whether things have changed. Is 5 years going to be enough?
End of February in 2030, see where we're at. Yep.
Do you reckon we'll still be here?
No, not a chance.
Maybe. All right. Look, I'm more optimistic. I think we will.
Right. Good.
Joe, thank you for your question, and thank you, Sean, for discussing it.
Thank you. Thanks, Joe. Thanks, Michael.
Remember, if you've got something that you would like to know, then please send through your question on LinkedIn, like Joe did, or Instagram, Facebook, or at fearandgreed.com.au. I'm Michael Thompson, and this is Ask Fear and Greed.